Hello and welcome back to Hashtag Real Estate, when we're taking a look at some of the advantages of indirect property investment when compared to direct property investment. Joining us for that discussion in studio is Craig Hutchinson. He's CEO of England Focus, as well as Eugene Marais, Managing Director of Wealthport.
Craig and Eugene, welcome to Hashtag Real Estate.
Thanks, Paul.
Thank you very much.
Gentlemen, tell me, what's the difference between indirect and direct property investing?
All right, so I think you don't mind, Craig?
Yes, no, please.
I think the major difference for people to understand is the direct property space is when you talk about a buy-to-let. So you understand the physical, tangible elements of property, and that's what makes property such an exciting and interesting and understandable concept for most people, because they see a tangible property. So that is the physical or the tangible property investing. Indirect property investing would be investing through a investment fund or a property fund, a unit trust, or an exchange-traded fund. So that's the fundamental differences, and they behave very differently. So if you take, for example, a client that looks to go and invest in a property market, you could have, so people have disposable income and they say, which should I rather do? Should I buy a flat, or should I put this into, for example, a property unit trust? Now let me explain the fundamental differences and what will benefit an investor when they make this decision. Your ability to borrow money or raise debt is an asset. So in most cases, if you have the ability to raise debt, then what I suggest you do is look at buying in the physical property market, because by leveraging yourself in a good asset, now there are bad assets and there's good assets. You know, for example, if you're taking debt, and I grew up, my father was from that generation that says you don't take debt, all debt is bad. It's not true. There's good debt and bad debt. Buying motor cars is terrible debt, but buying houses is good debt, provided they sweat, and in other words, they generate a rental. So for example, if you can raise debt, and you can go and buy a flat and you can rent it out, and after servicing your debt costs, even if there's a small portion that you're contributing, remember you're getting the benefit of the rental income and the property appreciation growth. Now, in today's market, it's quite difficult to raise debt. So that means that if it's difficult to raise debt, there are more people that need to rent, which means that your rental pool or your rental options become bigger. The only challenges, and I think probably Craig can touch on them, the challenges with owning physical property, because he's an expert on that, is that there's a whole lot of things around managing tenants, picking location, all those kinds of things that you need to be up for. But it is a sound investment to make if you can use your balance sheet. On the other hand, if you have disposable income, because no bank's going to lend you money against your property investment into a unit trust, for example. So that's a different type of investment. The advantage of having an investment in an indirect fund is that, for example, you have much more liquidity. So you can invest smaller, you can buy for a little bit, you can buy a property fund, and for example, if you didn't have enough money, you couldn't just go and buy the kitchen of a flat. You'd have to still buy the whole flat. And what happens if you needed some money in the interim? Would you sell the lounge or sell the kitchen? You can't do that. In a property fund you can. You contribute, start small. As it gets better, if you need liquidity, you can make a withdrawal. So it gives you that. And the difference there is what you're investing in companies who are specialists in property. So they will buy commercial property and they rent it out, and they fund those properties. So you must understand the dynamics of investing in an indirect fund has a couple of other differences. Remember, what you've got to understand when you're investing those is that what you're actually buying, or what is the value of the actual property that you're investing in, is the quality of the income streams it generates. Because often when we think about property, we think the price of property is determined by, you know, you walk into a house and it's beautiful and it feels nice and it's emotional, and you can imagine your kids playing in the garden, or if you're a bachelor, you might have a whole lot of other different ideas, but you know, buying that Manhattan penthouse. But that's all emotional decisions, and so you pay on emotion. When you're buying property to let, okay, it's a very different decision.
Yeah.
It's, can we get the value out of it? And that's the same as a commercial property fund manager would make.
Okay, so let me bring Craig into the conversation here. I picked up an article, certainly overseas, where it seems that, I mean, he's made the case for buy-to-let if you can raise debt, but seemingly buy-to-let is becoming unattractive to investors. Would you agree?
No, I disagree with that, because I think if you have a look at an idea with a gearing, that's a big positive. But you've just got to be aware of not to overgear, because you've got to ensure that if you do have a bad tenant, or if there is any issues with any of your properties, that you can sustain it in the long run. But it's a big positive to be able to gear that portfolio. Getting back to the buy-to-lets, you've also got to see what your investment criteria is. You know, do you have the time and the passion? because that's important. You must have the passion for the property, and you must also have the time to be able to run that portfolio if it's a strategic investment that you're looking at taking on. Whereas on the listed space side, other people are going to be worrying about the returns and what's happening. It's also then important, if you're looking at the indirect from an investment space, is who are those managers that are running those portfolios? What is their track record? Because when you look at the direct property holding, it's so important then, because you've got to look at certain criteria. You've got to look at location. Location is incredibly important. You've got to look at the strength of your tenant that you're putting in place. And it's always good to then involve professionals to make sure that you're getting the right tenant. Make sure you do all the right RTC checks around that. If you don't do it correctly, it can end up costing you money at the end of the day. So for me, important location, your passion for the property industry, and then also looking at the finishes of what you're acquiring. You want durable units that's easy to let.
I think Craig makes a wonderful point. I do both. I have property to let, and the one thing you've got to always think about when you're buying property to let is think about the tenant you're buying it for. A lot of people go in there and get emotional about a property and maybe overpay in an area, or they don't understand that a property is a function of the yield. It's what rental am I going to get for the amount of money I'm spending, and will this property appreciate? So going back to, if the location's correct, the property will appreciate, plus the rental, that gives you the total return. But if you're buying a property and you wouldn't live there, or you're buying a property and the kind of tenant you think that will attract is a problem tenant, don't make the investment. So they're always important to think, when I buy this property, who's going to be my tenant? Are they going to pay regularly? Are they going to look after my property? So I think that's a very valid point.
Yes, I think it's just not a matter of looking at the numbers. You can do a spreadsheet and there can be returns, but for property, you've got to go out there and you've got to find the right product for what you're looking for, that over the long-term period. Because property isn't a short-term game, direct property ownership. In the listed space, you can get in and out of it quite quickly. But in direct property, the shortest term is 5 years. Ideal term is 10 years. You don't want to be shorter than that. So you've got to make the right choice when you're investing in a property.
All right, let's hit a pause on the conversation for now. Do stay with us. We'll be back with more after the break. Welcome back to Hashtag Real Estate. If you've just joined us, we're taking a look at direct and indirect property investment. With us in studio is Craig Hutchinson, CEO of Ingle & Volkers, as well as Eugene Marie, Managing Director of Wealthport.
You missed out on an exciting discussion that we had in regards to discussing some of the differences between direct and indirect property investing and the advantages thereof. And I know we've gone to the extent of discussing as well good debt versus bad debt as far as investing is concerned, and we're definitely going to be looking at the return. So tell me, Eugene, what are some of the drivers of returns in between both direct and indirect investing?
The funny thing is, they're actually fairly similar. And a lot of it is, again, we talked about the gearing and interest rates. And that, if you, on a very simplistic level, if you look at interest rates, that's one of the biggest indicators of how a property may do. So let's take, for example, if you buy a buy-to-let, you're going to borrow money and you're going to get rental. If your borrowing costs goes up, what's going to happen? You're going to make less money because your costs are higher, your rental stays the same, and your property appreciation may be difficult to achieve, because in a higher interest rate environment, what's going to happen? There are going to be less people that are going to qualify for those types of bonds, so your demand side of your economy shrinks, which means the demand for property goes down. So your house prices may stay level for longer, and you've got this increased cost. So that's a negative, really, in the property market, is higher interest rates. Same in the commercial property space. In the commercial property space, the fund managers are obviously leveraging, buying property, and they're getting rental streams. So they're looking at the rental streams, and your return is based off the appreciation of those properties and the rental streams. So if the interest rate component goes up, you're going to find that's going to erode a part of the profit. And I think that's really important to understand in both cases as drives the trend. The other factors, though, for example, which is not so applicable in a buy-to-let market, because in the buy-to-let market, you have an isolated opportunity which is your apartment or your property. The moment you get into a unit trust, you're now part of a collective. And there are some other things that happen in that market in the sense that you now are buying a unit trust, or a REIT, as they call it, real estate investment trust. And that is also driven by the property fund managers. They buy each other's stock sometimes. So sometimes they can push the value of the stock up, which is not necessarily a true reflection of the value of the companies. And because it's a fairly illiquid sector, or a fairly small sector, you can have problems that have happened, for example, in the Resilient Fortress kind of scenario where one company falls out, the other holds its stock, and it can have a negative impact, and it has had on the property index of late, where you have these companies that have valuations that may be more reflective of some of the corporate activity and the buying of cross-holdings. So you are vulnerable as an investor in the direct space, which is why often, we can talk about the opportunities in which we can look at. But the drivers are very similar. In a rising interest rate environment, property funds as well as your buy-to-let market, the profitability or the returns are going to be adversely affected.
As an investor, obviously you're starting to state some of the risk that there is. Do you want to give us a bit of more, some of the examples from a risk perspective in direct and indirect?
Absolutely. So the one nice thing is that if you're buying a property and you've got a 10-year view, and exactly as Craig says, the nice thing about it, if interest rates do go up and your property prices, let's say, for example, stay flat, inflation should ultimately increase your rentals. So your rental stream, if you get good tenants, will always keep on going up, irrespective of the underlying property value, because you're not going to liquidate the property value. You're not going to sell it. You're in it for 10 years. So the underlying property value is not something you can realize on a year-to-year basis. Now, that's something. So you can forget about what the value of the property is because you are looking at the rental streams, and they're going up, and what is your bonds pretty much staying the same unless interest rates really blow out. If you're in the unit trust market, you must remember every time you cash in, you're then cashing in at the property value of the day. So if property values are going down, it affects the quality or the price of the overall unit trust because it's a function of both yield, the income yield, and the underlying valuations of the property. So again, going back to which the opportunities are. If you have the ability to raise debt and you can afford to buy real estate, physical property, do so. If you have investable assets and you like property, it's best if you're going to do a debit order or a small amount is to go into a property fund for liquidity. But again, there's a little bit more volatility that you'll see in the property market. The problem, again, because the property market or the unit trust market, the REIT market is less liquid, you have a situation where, in most cases, I'd say to someone, just buy the index rather than buy the fund because it's cheaper. And if you're looking for alternatives, then look for fund managers, and a good fund manager like Ian Anderson from Net Group who doesn't actually follow the index and does slightly different things. So what you're trying to look for when you're buying property is, if you are going to buy a guy who manages a fund, look at what he tries to do. But if you're buying any of the big funds, you're probably better off buying the ETF or the index because it's a lot cheaper and you're actually getting the collective wisdom, or if you're a cynic, the collective stupidity of the market.
I know Craig is updated about some of the affordable funds.
Yes, well, just to get back to the indirect holding as well, it always goes around the research. So if you're investing in a particular counter, you need to go and investigate around management and how they've been running the funds. Because often you see these good returns, like we had with Resilient, where it's too good to be true, and it was too good to be true. So that's where I also maintain tracker funds is a good way to expose yourself to the whole property market. But from an investment point of view, coming back to the direct side, there's a lot of units that are coming onto the market. For example, we've just partnered with one of the bigger affordable housing funds, where they've developed 33,000 units, and we've partnered with them on the sale of their initial funds that are coming to an end now. They've got a track record of being rented, very high quality in the right suburbs, right location, and we're selling approximately 4,000 units that's going to be coming onto the market in the next 3 years, which is about 5 billion rands worth of property. So that's exciting for the buy-to-let investor as well as the first-home owner.
So, clearly what I'm getting from the both of you is that there's no one method in which one needs to be looking at. In fact, you could probably use both of them to kind of spread the portfolio for risk.
Most definitely. I think property must form part of your investment portfolio. It doesn't matter what form it is in, but property must definitely be in your investment portfolio. And then I'd highly recommend then diversifying within that property portfolio. Where I'm talking, from a rental perspective, if you're in your main metropoles, there's always movement in your main metropoles, where we've seen the second home market. That's been a difficult market to be in.
Yeah.
And I think to go back, there's no good or bad time to invest in direct property. If you're taking the long-term 5 to 10 year view, whether it be a buyer's or a seller's market, if you have the ability to climb onto the property ladder, climb in sooner rather than later.
Thank you, gentlemen, for joining us and sharing that good insight.
Good.
Thank you.
Thank you very much.
Join us in discussion on social media. Follow us on Twitter @RealEstateBDTV and email us on realestate@bdtv.co.za.
And that's it for today's episode of #RealEstate. Thanks for joining us. Until next time, from myself and the rest of the team, goodbye.